Welcome to the research desk. Imagine looking at a corporate entity that completely dominates its domestic e-commerce landscape, right? It powers a massive portion of its nation's internet cloud infrastructure, and it consistently generates, we're talking tens of billions of dollars in free cash flow.
Yeah, an absolute cash machine on paper.
Exactly. And under normal circumstances, when we analyze a mature technology platform with that kind of footprint, the market valuation behaves almost like an engineering schematic. You map out the user base, you project the highly visible cash flows, you assess the total addressable market, and you arrive at a premium multiple. It reflects structural dominance. It's usually a very clean, rational exercise.
Right, but we are definitely not in normal circumstances here.
We are absolutely not. Today, we're looking at a financial landscape that is entirely divorced from that rational baseline. We are examining Alibaba Group. Trading in Hong Kong, currently commanding a market value in the neighborhood of $330 billion. And that number sounds massive until you realize we're talking about a business attempting a monumental turnaround following an era where it lost hundreds of billions of dollars in market capitalization.
Hundreds of billions. It's staggering when you actually look at the chart.
It is. It's a company that the market is essentially treating as if its best days are permanently behind it, despite the underlying engine continuing to hum.
Well, you're right to point out the disconnect, but I wouldn't call it divorce from rationality. I'd call it a highly rational response to an entirely new paradigm. When you look at Alibaba today, you are looking at a corporate structure and a valuation that carries immense, perhaps insurmountable historical baggage. The market isn't making a mistake here.
You don't think an 11.5 forward PE is a mistake for this asset?
I really don't. The market is meticulously pricing in a reality where the fundamental rules of engagement for this specific company have been rewritten. We aren't just looking at a business cycle. We're looking at a permanent recalibration of what this asset is actually worth.
And that brings us perfectly to the profound tension we need to unpack today. The central debate we're wrestling with is whether Alibaba's current state represents the early, unloved stages of a massive, multiple expanding recovery, something fundamentally akin to, say, the operational turnaround we saw with Meta back in 2022, or even Microsoft's legendary pivot in 2014.
Or, on the flip side, whether it has permanently transitioned into a mature, slow-growth value trap, destined to trade at a compressed multiple forever, much like the trajectory of Yahoo Japan in the 2010s.
Right, and we're grounding our entire analysis today in the latest investment framework data. Specifically, we're going to look through the lens of Alibaba's concentric circle market history. Now, I am taking the position that the operational repair taking place right now inside Alibaba is undeniable and, frankly, deeply underappreciated. They've executed a drastic reduction in headcount, their operating margins are significantly expanding, and they are generating massive free cash flow.
They are cutting costs, sure.
They're doing more than cutting. I see a highly disciplined giant that is being mispriced by lingering market trauma. It's sitting like a coiled spring, poised for significant upside as its cloud computing division reaccelerates.
Yeah, I approach this from a completely different angle. For me, the burden of proof is simply too high for anyone to credibly call this a classic turnaround play. Yes, the stock is cheap on paper, but it's cheap for a very specific reason. The overarching narrative that once commanded a premium multiple is permanently impaired.
Permanently is a very strong word.
But I think it's the accurate word here. The macroeconomic overhang in China, the fierce domestic competition, and the lingering regulatory realities, they are structural features now. They aren't temporary cyclical bugs. When you have top-line revenue growth that is steadily decelerating, that is entirely insufficient to break this company out of the valuation shadow it currently lives in.
Let's lay out the foundation for why I think the market is completely missing the boat here. And it really comes down to the mechanics of what I call the efficiency reset. I look at Alibaba today, and I see a financial engine that has fundamentally changed how it operates. We're talking about an entity that has completely overhauled its cost structure.
Through mass layoffs, mostly.
Well, yes, over the past couple of years, management has executed a reduction in workforce that is staggering in its scale, slashing tens of thousands of roles, pulling headcount down drastically from its bloated peak. Now, a lot of people see layoffs and they think distress. I look at that and I see a fundamental, structural transformation of the corporate DNA.
But you can't just cut your way to growth. Efficiency is great for a quarter or two of earnings beats, but it doesn't change the terminal trajectory of the business.
It absolutely can change the trajectory of the stock, though. In mature platform businesses, a ruthless commitment to cost discipline does significantly more for long-term shareholder returns than chasing a marginal, highly unprofitable point of top-line revenue growth. We saw this exact mechanism play out with Meta's famously dubbed Year of Efficiency in 2022.
The meta comparison?
Hear me out. Remember where Meta was? The market thought they were setting billions of dollars on fire building a metaverse nobody wanted. Apple's privacy changes had crippled their ad targeting, top-line growth had stalled, the stock was left for dead.
Right.
But when Mark Zuckerberg pivoted, stopped the cash incineration, drastically cut headcount, and shifted the absolute focus to margin preservation, the stock didn't just recover, it surged over 500%. The market multiple expanded rapidly because investors realized the underlying cash generation was pristine once the bloat was removed.
Yeah, but
Just to finish the thought, I look at Alibaba today trading at roughly 11.5 times forward earnings, and I see the exact same setup. The market is pricing this company as if it will never, ever grow again. That creates a highly asymmetric risk-reward profile. If their cloud and AI divisions merely meet moderate expectations, that 11.5 times multiple mathematically has to expand.
look, I hear that meta comparison thrown around constantly in value investing circles, but the mechanics of it just don't map onto Alibaba. I don't buy the parallel at all, and let me explain exactly why.
Go for it.
You are looking at a stock that is technically and fundamentally trapped. The cheapness you're pointing to, that 11.5 forward PE, is an illusion created by psychological anchoring to a past that no longer exists. The meta comparison completely fails because Meta was operating in an environment where it essentially held a global duopoly in digital advertising, backed by a robust U.S. macroeconomic environment.
The macro environments are different, certainly, but the mechanism of capital return?
Meta did not face the systemic political, regulatory, and intense deflationary macroeconomic ceilings that currently exist in the Chinese market. The terminal narrative is what dictates the multiple. A much more accurate and frankly much more sobering parallel for Alibaba is Yahoo Japan.
Yahoo Japan? That's pretty harsh.
It's realistic. Let's look at the mechanics of what happened there. Yahoo Japan was a company that remained incredibly dominant in its home market for decades. It was highly profitable, it was ubiquitous, it generated massive amounts of free cash flow, and just like Alibaba is doing now, Yahoo Japan used that cash to aggressively buy back its own stock.
And buybacks are mathematically supportive of EPS.
On paper, yes. If you looked purely at their balance sheet and the cash flow statement, it looked like a screaming buy. Yet it suffered permanent, relentless valuation compression. The multiple shrank year after year after year.
Because they missed the transition to mobile?
Because the market collectively stopped believing in its forward-looking growth narrative. Investors realized the terminal value of the business was stagnant. A company can be highly profitable, it can buy back shares, it can expand its margins through cuts, and it can still be an absolute black hole for investor capital if the broader market decides the multiple never deserves to re-rate. That is the maturity trap, and that is exactly where Alibaba is sitting today.
That is a well-articulated bear case, I'll give you that. But I think to really understand why the market treats Alibaba's current, very real cash flows with such extreme skepticism, we have to look at the historical psychology. We have to look at how past narratives dictated its market capitalization.
The concentric circles framework.
Exactly. Let's walk through the concentric circles of narrative history. This is a brilliant way to map Alibaba's market history as a set of expanding and contracting rings of belief. We have to walk through each ring to understand the scar tissue.
It really is the only way to understand the institutional fear right now.
Right, so let's trace it back, the innermost foundational ring of the modern era. Let's look at the 2014 to 2020 period. This was the era of the China Internet King. The narrative during this massive multi-year expansion was simple and incredibly intoxicating for global capital. Alibaba was the toll booth for the rising Chinese middle class.
If you wanted exposure to China, you bought Alibaba.
Exactly. And we saw the valuation rings expand outward. We saw it climb walls of worry, like the 2018 trade tensions, where the stock took a hit but then surged right back. Why? Because the underlying engine was proving itself. They proved they weren't just a consumer proxy. They were building Alibaba Cloud. They were becoming the AWS of Asia. This culminated in the outermost ring, the absolute peak of the market cap, at roughly $860 billion.
Okay, but we have to be brutally honest about what built that specific outer ring. That $860 billion peak was not built purely on the fundamentals of selling goods on Taobao or hosting data on the cloud. That valuation was an anomaly.
It was pricing in a lot of future growth, yes.
It was a product of a very specific, entirely unrepeatable cocktail of global conditions. We had 0% interest rates flooding the world with liquidity. We had the artificial pandemic-driven pull forward of global e-commerce adoption, which made growth rates look entirely parabolic. And most importantly, we had the absolute euphoria surrounding the impending Ant Group IPO.
The fintech arm, right?
The market had hallucinated that Chinese technology platforms were essentially unregulated sovereign entities. Investors were pricing in a future where Alibaba's financial arm would dominate global fintech without traditional banking capital requirements or any regulatory oversight whatsoever.
It was definitely a period of peak optimism. The multiple expanded because the perceived total addressable market seemed infinite.
But the most important characteristic of that $860 billion outer ring is how dangerously thin and fragile it actually was. It wasn't built on a concrete foundation. It was built on glass, and we all know exactly what shattered it.
The regulatory crackdown.
The cancellation of the Ant IPO, the subsequent multi-billion-dollar antitrust fines, and the sweeping regulatory changes. The market capitalization violently contracted, moving from that $860 billion peak all the way down to the smallest inner ring, the roughly $80 billion trough during the darkest days of the 2020 to 2022 regulatory crackdown.
Which was an incredibly painful recalibration for anyone holding the stock.
Painful is an understatement. When a company loses hundreds of billions of dollars in value that rapidly, it doesn't just erase wealth. It destroys the foundational trust that global allocators had in the entire asset class. You have to understand the mechanics of institutional investing.
The risk premium.
Exactly. When sovereign wealth funds, massive pension programs, and global asset managers see a state apparatus step in and alter the fundamental business model of a dominant company overnight, they are forced by their risk departments to rewrite their models. They have to apply a permanent structural risk premium to Chinese equities. That is the $80 billion trough ring. It was the market saying, this asset is functionally uninvestable because we cannot model the regulatory tail risk.
Right.
That scar tissue is permanent. It is exactly why an 11.5 times forward earnings multiple is now considered the normal baseline, rather than an absurdly cheap anomaly. The market is saying the growth ceiling is permanently capped.
I hear you, and I understand the psychological trauma of that $80 billion trough. But here is where your thesis breaks down for me. You are assuming the narrative is permanently stuck in 2022. You're assuming the scar tissue is the only thing that matters. But the reality is, while that outer $860 billion ring shattered and the stock crashed into that $80 billion trough, the underlying utility of the business never actually disappeared.
The margins compressed massively, though.
But the core commerce platforms, Taobao and Tmall, they continued to process hundreds of billions of dollars in gross merchandise value. The cloud infrastructure continued to host vast swaths of the Chinese internet. The narrative broke, the multiple broke, but the actual cash-generating machine did not. And that brings us to the current cycle, the ring we are living in right now from 2022 to the present. We are in the recovery ring, sitting at roughly a $330 billion valuation.
A recovery that is stalling out, I would argue.
But a stabilization nonetheless. The market has moved past the existential terror of the $80 billion trough. The narrative today is no longer about sudden regulatory death. It's about stabilization, aggressive shareholder returns, and the early stages of artificial intelligence monetization. So we are currently valuing this entire enterprise at $330 billion. Now, the framework poses a fascinating question. Can this current recovery cycle expand outward?
Can it become the new outermost ring and eventually exceed that historical $860 billion peak?
I'm going to stop you right there.
Let me just give the math.
To achieve what the framework calls escape velocity and breach that all-time high, the math dictates that the stock requires roughly a 2.6 times multiple expansion from its current levels. And that 2.6 times expansion is exactly where the entire bullish thesis falls apart for me. Mathematically and psychologically, expanding a multiple by 2.6 times for a company of this sheer size is virtually impossible without a return to explosive, undeniable hypergrowth.
I think that's too rigid.
You have to look at the mechanics of who actually drives multiple expansion in public markets. It's driven by institutional momentum funds and growth-oriented asset managers. Those allocators demand accelerating top-line growth. They want to see a company proving it can take massive new market share, growing revenue at 20, 30, or 40% year over year. A mature, massive company that is seeing its revenue decelerate mathematically cannot command the premium multiple required to add over $500 billion in market capitalization.
But they don't need to add $500 billion to be a good buy today.
If the top line isn't exploding, the momentum funds will stay entirely away. That leaves the stock wholly reliant on value investors. And value investors, by their very nature, are notoriously stingy with multiples. They will happily hold it at 11 or 12 times earnings for the cash flow, but they are never going to pay 25 or 30 times earnings for it. Therefore, that $860 billion outer ring is permanently out of reach.
I think you're anchoring entirely too much to the idea that we absolutely must achieve that $860 billion escape velocity for this to be a phenomenal investment. We simply do not need to reach the outer ring to generate highly lucrative market-beating returns from where we sit today at $330 billion.
So you're settling for a stagnant multiple?
I'm looking at the mechanics of capital return because this is where the downside is mathematically capped. Look at what management is doing with the cash they generate. They're executing massive buyback programs, retiring billions of dollars of stock, and they have initiated dividend payments.
But as we discussed with the Yahoo Japan analogy, buybacks do not guarantee a rising share price if the terminal multiple is compressing faster than you can retire shares.
Right, but it creates a fundamental floor beneath the stock. When you combine a solid dividend yield with a ferocious rate of share repurchases, you are organically increasing the earnings per share. Think about the basic math. If the overall net income of the company stays perfectly flat, but you reduce the number of outstanding shares by 5 or 6% a year, the earnings per share automatically rises by that same 5 or 6%.
Assuming margins hold up.
Exactly. And over a multi-year horizon, that compounds significantly. You are literally paying investors to wait for the broader sentiment to shift. And it doesn't take hypergrowth to shift sentiment. It just takes a normalization of the operating environment. If that 11.5 times multiple just normalizes to a highly conservative 15 or 16 times as the regulatory fears continue to fade in the rearview mirror, the upside from the $330 billion level is tremendous.
I have to challenge the premise that these massive buybacks and dividends are purely a sign of underlying strength. I look at those exact same capital return metrics and I see a glaring implicit admission of a lack of internal reinvestment opportunities. This is the absolute hallmark of a maturity trap.
That's a very growth purist way of looking at it.
It's the reality of a dominant tech platform. For years, Alibaba took every single dollar of free cash flow and aggressively plowed it back into the business, subsidizing new logistics networks, fighting price wars and local services, expanding into Southeast Asia. They were a growth engine. When management suddenly pivots, stops aggressively reinvesting into expansion, and instead starts handing out dividends and retiring shares, they are broadcasting a very clear signal to the market.
That they are mature.
That they are essentially saying, we have saturated our core markets, and we no longer have high-return internal projects that can efficiently absorb this capital. Handing cash back is a nice feature for a utility company or a mature consumer staples brand, where for a former hypergrowth tech giant, it is often viewed by the market as a concession of defeat.
I understand why you view it that way, but I think that is an incredibly dogmatic way to look at corporate finance. Capital allocation absolutely must evolve in tandem with the corporate lifecycle. The absolute worst thing a mature tech platform can do, The thing that genuinely destroys shareholder value is to arrogantly pretend they are still a startup and burn billions of dollars on low-probability side ventures just to maintain the illusion of top-line growth.
Well, no one is advocating for burning cash.
But that's what happens when you refuse to acknowledge maturity. Acknowledging maturity and shifting to disciplined capital return at deeply compressed multiples is precisely what highly intelligent, shareholder-aligned management should do. But let's move beyond the theory and actually test the underlying engine. Because for this recovery narrative to hold any water, for the $330 billion ring to expand, the business must structurally pass the 4 critical fundamental walls.
Let's look at the data then.
Exactly. Let's look at the first fundamental wall, revenue growth. Now, the data shows top-line growth is in the green, meaning it is positive, but we cannot ignore the trajectory. Revenue growth is decelerating, moving from an 18% rate down to roughly 12.8%.
And that deceleration from 18 to 12.8% is exactly what terrifies the institutional money. It proves the structural ceiling thesis. You cannot analyze that revenue slowdown in a vacuum. You have to look at the mechanics of why it is happening. Alibaba is fighting a brutally intense multi-front war in its core domestic e-commerce market. We are talking about the rise of Pinduoduo and the algorithmic commerce dominance of Douyin.
The competitive landscape has undeniably intensified. Pinduoduo's value for money positioning really hurt Alibaba during the macro slowdown.
Exactly. For years, Alibaba dominated because Taobao and Tmall were the default search engines for shopping. If you wanted something, you opened the app and searched for it. But the paradigm shifted. Douyin introduced algorithmic feed-based commerce. Consumers aren't searching anymore. They're scrolling. The algorithm is serving them products they didn't even know they wanted, seamlessly integrated with entertainment.
It's a completely different discovery mechanism.
Right. Meanwhile, Pinduoduo completely gamified the discount shopping experience, capturing the price-sensitive consumers in lower-tier cities that Alibaba had somewhat neglected while focusing on premium brands. This forced Alibaba into a desperate margin-compressing price war just to maintain its market share. The revenue is decelerating because they no longer have monopoly pricing power. They are having to heavily subsidize merchants and consumers just to keep them in the ecosystem. That 12.8% is a hard-fought, bloody metric, not a natural organic expansion.
I won't deny the ferocity of the domestic price war. Pinduoduo and Douyin are formidable competitors. But you can't look at that sluggish, decelerating revenue growth in a vacuum, because while the top line is facing pressure, the way management is handling the bottom line completely flips the script. This brings us to the second fundamental wall, operating margins.
This should be interesting, given the price war.
It is. Despite fighting that brutal price war you just described, the data is entirely in the green and actually accelerating. We are seeing operating margins expand from 12.5% up to 17.5%. This is the cornerstone of my entire bullish thesis.
It is counterintuitive, I'll admit. How do you expand margins by 500 basis points while fighting a price war?
You do it through absolute operational ruthlessness. This is the efficiency reset in action. They aren't expanding margins by raising prices on consumers, they are doing it by fundamentally re-engineering the cost structure of the company. We talked about the massive headcount reductions, but it goes deeper. They have slashed bloated sales and marketing budgets. They have optimized their server utilization in the cloud division to squeeze more compute power out of existing infrastructure.
Right, cutting the fat.
They've ruthlessly shut down or spun off peripheral, cash-burning bets that weren't contributing to the core ecosystem. To see a company face severe top-line headwinds, fight a war for market share, and still manage to accelerate operating margins from 12.5% to 17.5% is a masterclass in execution. It proves that the core platform is incredibly resilient and inherently profitable once the management team stops prioritizing vanity metrics.
The margin expansion is impressive on paper. I will concede that management has executed the cost-cutting phase effectively. But optimizing a mature business only gets you so far, which leads us directly into the third fundamental wall, capital efficiency. Specifically, we are looking at the return on invested capital, or ROIC.
Which is also in the green.
Is marked green. Yes, noting that ROIC is rising to 10.8%. Now, 10.8% is a solid number. It indicates that the company is generally creating value above its cost of capital. But let's be intellectually honest about what a 10.8% ROIC actually represents in the context of a technology platform.
It represents a highly profitable, cash-generating business.
It represents a fundamentally moderate business. It's a good return, but it is absolutely not the high teens or low 20s elite return profile that commands a premium valuation multiple in the public markets. Think about the mechanics of ROIC. It measures how effectively a company uses the capital it raises to generate profits.
Right.
During the hypergrowth phase, tech companies can often generate massive ROIC because software and network effects scale infinitely without requiring massive new capital outlays. But Alibaba is increasingly capital intensive. They have to invest heavily in physical logistics infrastructure for Cainiao, and they have to spend billions on data centers and high-end GPUs to remain competitive in the cloud and AI race. A 10.8% return suggests that for every dollar they plow back into these physical and digital infrastructures, the incremental return is steady, but it's not spectacular. It confirms the thesis that the days of infinite capital-light scaling are over.
I disagree that it needs to be an elite 20% ROIC immediately to justify an investment today. You have to look at the trajectory. The fact that the return on invested capital is rising to 10.8% while they are simultaneously transitioning their infrastructure to support next-generation AI workloads is a highly positive signal.
It's acceptable, not elite.
It means the core commerce cash cow is strong enough to fund the capital-intensive future without destroying shareholder value. And that leads perfectly into the fourth fundamental wall, valuation. We've touched on this, but it bears repeating. The valuation is marked solid green, with the company trading at roughly 11.5 times forward PE. Let's really dig into what that number means.
It means it's cheap for a reason.
When you buy a company at 11.5 times earnings, you're essentially getting an 8.6% earnings yield right out of the gate. You're buying a balance sheet that is virtually bulletproof, holding billions in net cash. I look at this and I see the exact same psychological setup we saw with Microsoft back in the 2013 to 2014 era.
Oh, the Microsoft analogy again. It's a favorite for value investors, but it requires a massive leap of faith to apply it to a Chinese e-commerce company.
It requires looking at the mechanics of market sentiment. Think about Microsoft in 2014. Right before Satya Nadella really took the reins, the market uniformly assumed the PC market was facing terminal stagnation. Mobile had bypassed them entirely, Windows 8 was a disaster, and the stock traded at 10 to 12 times earnings for years.
Sure.
Investors thought it was a giant, cash-producing dinosaur. But what the market missed was that underneath the stagnant headline numbers, Microsoft was building Azure. They were building a massive, recurring revenue cloud infrastructure business. Once Azure hit critical mass and proved itself as a legitimate, high-margin growth engine, the multiple didn't just expand, it exploded. The stock went from being priced like a dying utility to being priced like an elite growth asset again.
But Alibaba Cloud is in Azure.
Alibaba right now is priced at 11.5 times earnings because the market is hyper-focused on the stagnant PC equivalent, the mature, highly competitive domestic e-commerce business. But underneath that, they are building the Azure of Asia. Aren't you demanding absolute perfection from a stock that is currently priced as if disaster is imminent?
I am not demanding perfection at all. I am demanding a tangible, realistic catalyst. And the history of the stock market is littered with the corpses of cheap companies. Cheapness, by itself, is not a catalyst for multiple expansion. A low PE ratio just tells you what the market thinks of the company's future. It doesn't force the market to change its mind. Value traps are filled with dominant companies that have incredibly healthy balance sheets, generate tons of cash, and trade at 10 times earnings forever because their terminal growth rate has permanently flattened.
So what would it take for you?
If we agree that cheapness alone isn't going to move the needle, we have to meticulously examine what specific, tangible triggers could force the institutional market to recalibrate and re-rate this stock, or conversely, what could derail this fragile $330 billion recovery narrative entirely?
Well, the catalysts are clearly identifiable, and they revolve almost entirely around the infrastructure of the future. The primary bull catalyst, the thing that breaks the stock out of this valuation shadow, is the cloud division. Specifically, we need to see Alibaba Cloud revenue growth convincingly break back above the double-digit threshold, say 10 to 15%, combined with the successful, scalable monetization of their Q-in artificial intelligence models.
That is a very big if.
Let's look at the mechanics of how this could play out. We can easily build a highly realistic scenario where enterprise AI spending in China and the broader Asian market begins to mirror the massive infrastructure boom we saw with AWS and Azure in the US between 2016 and 2019. If you are a Chinese enterprise, whether in manufacturing, finance, or retail, and you want to integrate generative AI into your workflows, you need compute power. You need foundational models.
And you think Alibaba captures all of that?
Alibaba is positioning Qwen to be the default domestic infrastructure for that integration. If that thesis plays out and the cloud division becomes the clear, undisputed growth engine, it completely fundamentally lifts the margin and revenue profile of the entire consolidated group. It forces institutional allocators to run new discounted cash flow models, and it will absolutely force the massive short interest in the stock to cover their positions, creating a violent, powerful upward momentum dynamic.
That is a pristine, mathematically beautiful theoretical scenario. But as an investor, I have to look at the practical reality of the environment they are operating in. Let's talk about the mechanics of Chinese enterprise IT procurement, because it is fundamentally different than the US market.
In what way?
You are hoping that Alibaba Cloud can perfectly replicate the software as a service margin profile that makes Microsoft Azure so incredibly profitable. But historically, Chinese companies have been intensely reluctant to pay recurring subscription fees for intangible software. They heavily prefer customized, on-premise solutions that they own outright. It is a much lower margin, highly labor-intensive consulting business model compared to the highly scalable, self-serve SaaS model in the West.
That's changing, though, with AI. You can't easily host these massive foundational models on premise without spending a fortune.
Perhaps. But we have to acknowledge the reality that massive capital expenditures in AI might simply create market excitement without ever creating actual distributable profits. We are seeing Alibaba, like everyone else, require to spend billions upon billions of dollars to buy high-end GPUs and build out data centers just to train these foundational models. The return on investment for that Capex is entirely unproven.
It's table stakes for the next decade of tech.
But it's entirely possible they spend $10 billion on AI infrastructure just to maintain parity in a commoditized market with zero pricing power to actually earn a return on that investment. And beyond the fundamentals, look at the actual price action. Look at the chart. The stock is currently exhibiting highly volatile, exceptionally choppy trading behavior. It is consistently failing to break out above its resistance levels.
It takes time to build a base after an 80% drawdown.
Look at how the market reacted to their most recent earnings report. The company posted objectively decent numbers. They announced a massive expansion of the buyback program. And what did the stock do? It dropped sharply in a single day. That is a glaring, blinking red flag. It indicates that the institutional market actively disbelieves management's forward-looking guidance. When you hand the market a platter of good news and the stock still sells off aggressively, it tells you that the underlying sentiment is deeply structurally cynical.
I mean, sentiment is washed out, yes.
The real risk here is not just stagnation, it's a technical breakdown. If the stock falls below its established support levels, it signals a complete reversion to the deep skepticism of the $80 billion trough, and the entire recovery thesis completely unravels.
The sentiment is undeniably cynical right now. I will completely grant you that. But I want to remind you of the mechanics of how major tech recoveries actually play out in this specific market. Think back to the Tencent recovery playbook in 2022. It's an almost perfect parallel.
Tencent is a very different beast.
But look at the setup. Tencent was facing incredibly intense regulatory pressure, primarily around gaming approvals. Their margins were compressing, the macroeconomic environment was bleak, and global sentiment was entirely washed out. Everyone said Tencent was uninvestable. But what happened? Management focused on what they could control. They stabilized their returns, they ruthlessly cut costs, and the cash generation remained incredibly robust.
Right, and the stock eventually recovered.
Exactly. Because of that fundamental floor, the stock became highly investable for smart money well before the broader market sentiment actually recovered. The operational repair always precedes the sentiment repair. The market is a lagging indicator of internal corporate efficiency. Alibaba is following that exact same playbook right now. They are fixing the engine while the car is still in the shop, and the market won't price it in until it's already back on the highway.
The Tencent analogy definitely has merit, and I respect the mechanical comparison. But I would counter that Tencent's core businesses, specifically its absolute stranglehold on social networking via WeChat and its dominant position in domestic gaming, they enjoy a much stronger structural monopoly and significantly higher pricing power than Alibaba possesses in the highly contested e-commerce sector.
The gaming market has its own risks, though.
Yes, but Tencent operates a true toll bridge. Alibaba is operating a massive retail bazaar where two other massive bazaars just opened up across the street. E-commerce in China is simply not a winner-take-all market anymore. It is a brutal, margin-compressing battleground. And that fundamental difference in moat quality is exactly why Tencent's multiple recovered faster than Alibaba's will.
That is a fair distinction regarding the core moat, but that is exactly why Alibaba's aggressive shift toward operational efficiency and their massive investments in the cloud matters so intensely. Management knows they aren't going to win a race to the bottom in consumer e-commerce against Pinduoduo. That's a fool's errand. Instead, they are intelligently leveraging the massive cash flow generated from that mature, slow-growth commerce business to fund the digital infrastructure of the future. They are using the cash cow to build the next engine.
If the next engine actually works.
Right. Let's pull all of this complex data together and summarize our positions, because despite our stark disagreements on the terminal trajectory, the framework actually leads us to a highly actionable conclusion. I firmly maintain that the operational repair occurring within Alibaba is unequivocally real and deeply underappreciated by the broader market.
The margins are up, I agree with that.
The drastic headcount reductions and the fundamental shift in corporate culture have structurally altered the cost base, which is empirically proven by the acceleration in operating margins from 12.5% to 17.5%. The sheer scale of their free cash flow generation provides an incredibly robust floor, especially when management is intelligently deploying that cash through aggressive share repurchases at currently depressed valuations. I believe the stock fundamentally does not need to achieve escape velocity or return to its $860 billion glory days to be a phenomenal investment.
A return to a normal multiple.
A simple, rational normalization of market sentiment driven by a credible reacceleration in cloud computing creates massive, highly asymmetric upside from this compressed 11.5 times forward PE level.
And I will maintain my position that while the downside may indeed be mathematically buffered in the near term by the buyback yield and the sheer weight of the cash flow, the structural ceilings on this company are equally hard and unforgiving. The deflationary macroeconomic environment in China, the brutal and unrelenting competitive landscape in their core e-commerce business, and most importantly, the lingering institutional scar tissue from the regulatory crackdown, they place a permanent heavy lid on the valuation multiple.
The Yahoo Japan scenario.
Exactly. Without an explosive, undeniable, and sustained reacceleration in top-line growth to fundamentally alter the market's terminal narrative, a return to anything resembling its former multiple is highly unlikely. The risk of this asset becoming a stagnant, slow-motion value trap remains heavily elevated.
Yet what I find most fascinating about this entire analysis is that despite our fundamentally different weightings on the narrative history, despite disagreeing on whether the $330 billion recovery ring can ever expand outward, we actually arrive at a point of complete convergence when it comes to the practical portfolio-level execution.
We do. When you run the framework's final investment checklist, you have to look at it objectively. The core fundamentals are technically improving. Margins are up, ROIC is up, even if the top-line growth is no longer elite. The sentiment is highly favorable from a contrarian perspective specifically because it is so completely washed out. There's very little optimism left to disappoint.
The bar is incredibly low.
And the long-term price trend, while volatile, is showing signs of basing and stabilizing. Because of those factors, we both agree with the framework's final verdict. Alibaba is a buy, but we must be incredibly precise about how that is executed. It is strictly a buy as a highly disciplined 2 to 3% initial portfolio position. It is absolutely not a back-up-the-truck, high-conviction core holding. It is a position to initiate slowly, utilizing market weakness to build a base.
Precisely. The mechanics of the trade dictate caution. We only advocate organically increasing that portfolio weight toward a maximum of 5% if, and only if, the fundamental thesis proves out. Specifically,
An investor should only add to the position if cloud growth convincingly breaks out of the single digits and proves that the new AI-driven growth engine is an empirical reality, not just a management talking point. It is a highly measured, deeply disciplined approach to what is arguably one of the most complex financial assets in the global markets today.
This company truly serves as a fascinating real-time case study in the life cycle of market narratives. We have literally watched this entity expand and contract through distinct rings of global psychology. We saw the sheer unbridled optimism of the early era. We witnessed the absolute euphoria of the $860 billion peak. We lived through the sheer terror of the $80 billion regulatory trough. And now we are analyzing the sober, mechanics-driven reality of a $330 billion recovery phase.
It is a powerful, almost sobering reminder for anyone managing capital in the modern era. Exceptional operational execution, ruthless cost-cutting, and massive cash generation can successfully rebuild a company's balance sheet, and it can absolutely stop a stock from falling into the abyss. But at the end of the day, only undeniable, forward-looking, top-line growth can actually rebuild institutional market trust and force the multiple to expand.
This is the research desk officially signing off.